Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Affirm Holdings Inc. quarterly report. Affirm Holdings Inc. offers a range of businesses and services through its payment network platform. The company provides point-of-sale payment solutions for consumers, as well as merchant commerce solutions that enable businesses to offer flexible payment options to their customers. The platform allows consumers to pay for purchases over time, with agreements in place with originating banks and capital markets partners. This service is available to a wide range of merchants, including small businesses, large enterprises, direct-to-consumer brands, brick-and-mortar stores, and companies with an omnichannel presence. Affirm's merchants span various industries such as sporting goods and outdoors, home and lifestyle, travel and ticketing, electronics, fashion and beauty, equipment and auto, and general merchandise. By providing flexible payment options, Affirm enables consumers to make purchases that fit their budgets and financial needs, while also supporting businesses in offering a seamless shopping experience for their customers. Affirm Holdings Inc. market capitalization of $23 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Affirm Holdings Inc. holds a significant advantage in their industry. Affirm Holdings Inc. trades at a higher price-to-earnings ratio of 61 times and a higher price-to-book ratio of 5.96 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance. Revenue growth is primarily driven by several key factors. Firstly, an increase in interest income has contributed significantly to revenue growth, with a notable 32% year-over-year (YoY) increase. Additionally, the growth in gain on sales of loans has been substantial, rising by 68% YoY. The expansion of merchant network revenue has also played a crucial role, with a 25% YoY increase. Furthermore, an increase in gross merchandise volume, GMV, and servicing fee revenue have contributed to revenue growth. On the other hand, revenue decline is primarily driven by several key factors. Firstly, a decrease in other income has had a significant impact, with a notable 60% decline from 2025 to 2026. Additionally, an increase in loss on loan originations has also contributed to revenue decline, with a 44% and 69% increase for the 3 and 9 months ended March 31, 2026, respectively. Furthermore, an increase in merchant incentives, recorded as a reduction of revenue, has also had a negative impact on revenue growth. In conclusion, the primary drivers of revenue growth or decline are largely influenced by changes in interest income, gain on sales of loans, merchant network revenue, GMV, and servicing fee revenue, as well as losses on loan originations and merchant incentives. The financial performance of a company has shown significant improvement over the past year. In terms of net income, there was a substantial increase from $2.8 million in CONE 2025 to $102.9 million in CONE 2026. This upward trend continued throughout the year, with YTD 2026 net income reaching $313.2 million, a stark contrast to the -$17.1 million recorded in YTD 2025. The improvement in net income is also reflected in the company's profit margins. The operating income margin increased from -1% in CONE 2025 to 8.5% in CONE 2026 and further improved to 8.7% by the end of YTD 2026. Additionally, the balance as of March 31, 2026 showed a significant increase in profit margins, reaching 57.7%, up from 52.2% on December 31, 2025, and 55.4% on September 30, 2025. The reasons behind this improvement are not explicitly stated, but it is likely due to various factors such as cost-cutting measures, increased revenue, or a combination of both. Whatever the reason, the company's financial performance has shown significant improvement over the past year, indicating a positive trend for future growth and profitability. The company's financial performance indicates a strong ability to generate cash from its core operations. For the 9 months ended March 31, 2026, the company reported a significant amount of net cash provided by operating activities, totaling $934.8 million after adjustments. This positive operating cash flow is a crucial indicator of the company's financial health and stability. In comparison to other activities, such as investing and financing, the company's operating cash flow stands out as a notable achievement. While there were significant amounts of net cash used in investing activities, $1.4 billion, and provided by financing activities, $1.1 billion, the positive operating cash flow suggests that the company is generating sufficient cash from its core operations to support its growth and development. Overall, this indicates that the company is on a solid financial footing, with a strong ability to generate cash from its core business. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, total debt has increased by 15.1% from $8,085,919 to $9,358,170, with a notable increase in funding debt from $1,622,808 to $2,417,705. However, convertible senior notes have decreased slightly from $1,153,000 to $1,128,617. In terms of interest expenses, there has been no significant change, but cash payments for interest expense have increased by 3.7% or $11,436. The total interest expenses have also increased from $4,440 in 2025 to $8,083 in 2026. These changes suggest that the company's debt level and interest expenses are on the rise, which may have implications for its financial health and future performance. Management is optimistic about the company's outlook, focusing on building a next-generation payment network that promotes responsible spending solutions. They anticipate seasonality in business due to consumer spending patterns and are prepared for potential fluctuations in capital markets. To mitigate risks, management plans to optimize underwriting to manage delinquency rates and leverage a diverse capital ecosystem to support resilience across various conditions and economic cycles. The company is also expecting to sustain profitability over time, with a significant portion of the domestic valuation allowance potentially no longer needed. The platform is growing, with a 22% increase in active consumers driven by high retention rates and new consumer acquisitions through merchant and partnership expansions. Management maintains a capital-efficient model through diverse funding sources, despite macroeconomic uncertainty, and proactively manages the allocation of loans across various funding channels. The company has made significant acquisitions and divestitures in the past year. In terms of acquisitions, the company purchased a substantial amount of loans from originating bank partners, totaling $9.4 billion in the 3 months ended March 31, 2026, and $28.9 billion in the 9 months ended March 31, 2026. This trend continued in the previous year, with purchases of $7.1 billion in the 3 months ended March 31, 2025, and $21.6 billion in the 9 months ended March 31, 2025. In addition to purchasing loans, the company also originated or purchased loans from originating bank partners. On the other hand, the company has made divestitures by selling loans to third-party investors. Specifically, it sold interest-bearing monthly installment loans worth $4.3 billion, 86% of total unpaid principal balance, and 0% APR monthly installment loans worth $700 million, 14% of total unpaid principal balance. The company also engaged in the sale of loans through forward flow arrangements and securitization transactions with whole loan buyers and securitization investors. That concludes the financial summary for Affirm Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.